Hello everyone, welcome back to the course Strategic Management Accounting. This is topic 3, Strategy in the Market, Strategic Pricing Decisions. And this is lecture part 2 of this particular topic. In the previous lecture, which was the part 1 of this topic, I mentioned that this topic was organized around 3 key themes. The first one was neoclassical economic model of pricing and accounting model of pricing. We discussed these two models of pricing together with their weaknesses. And then the second theme was strategic pricing. We discussed how pricing should be carried out as a strategic act of enabling and enacting a particular positioning strategy together with other marketing decisions such as product, place and promotion. And we discussed this strategic positioning need to be carried out with 3 specific strategic acts: segmentation, targeting and positioning, or STP marketing. So that is what we discussed in our previous lecture. And in this lecture, we will concentrate on the third theme, a couple of strategic costing methods, namely target costing and life cycle costing. So, after following this lecture and after reading the recommended readings for this particular topic, you should be able to explain target costing and life cycle costing as 2 specific costing methods related to strategic pricing. So that is the learning objective for this particular lecture. Let's talk about target costing. The very first thing that I should emphasize about target costing is that target costing is not a specific technique or a method of calculating or estimating the cost of a given cost unit. As you studied in your previous management accounting courses, costing techniques such as, for example, job costing, process costing, contract costing, absorption costing, and even activity-based costing can be used to calculate or to estimate the cost of a given cost unit, a product or a service. In contrast to them, target costing is not such a specific technique or method of calculating or estimating the cost of a given cost unit. Instead, target costing is a broader managerial approach that you would use to manage your cost strategically so that you can create a viable strategic positioning in the market through which you can gain a competitive advantage over your competitors. So in a broader sense, target costing is a broader managerial approach to manage your cost, not a specific technique or method of calculating or estimating cost of a given cost unit. Target costing initially became popular during late 1970s, 80s and then during 1990s as a key element of Japanese management techniques. Companies such as Toyota and Nissan invented them and popularized them as a one big element of their overall package, overall system of managing their corporations. Target costing constitute one key element of the total package of Japanese management, which also involved, for example, total quality management, continuous improvement or Kaizen, and lean manufacturing. So the target costing should be understood as a broad managerial approach that supplement, that go together with many other Japanese management techniques such as total quality management, lean manufacturing, continuous improvement, quality circles, and so on. So that is the broad understanding that we have to first have in order to appreciate target costing. To repeat and to emphasize, target costing is not a specific technique or method of calculating or estimating cost. Instead, target costing is a broad approach to manage your cost. Now, in order to have a better understanding of target costing as a broader managerial approach, we should first start with a particular concept that Robin Cooper and his colleague Regine Slagmulder popularized, the concept of survival zone or the triangle of survival zone. According to this concept, a firm should operate within a survival zone, and that survival zone is defined by three highly interrelated marketing variables. The first one is price, and second one is quality, and the third one is product features or functionality. Now these three variables are highly interrelated because each of them are defined in relation to the others. Now, for example, you cannot define the price without thinking about the level of quality and the functionality that your product or service offers to the customer. So there should be a high connection between the price that you charge and the level of quality and the level of functionality. So they collectively define your survival zone. Then, in order to define the survival zone, in relation to each of these variables, you have to have a maximum target and a minimum target. So there is a particular maximum price level beyond which you can't charge a price, because given the level of quality and the product features that you have in your product or service, you can't charge a price beyond that particular point. Then there won't be a demand. Similarly, you can't charge a price below a particular point. If you charge a price below that particular point, obviously you would have a larger demand, but you would not be able to recover your cost. So that is the floor, the cost. Below that particular point, any price would not be financially viable. So like that, for quality as well as for functionality, you have a minimum and a maximum limit. So your survival zone is determined by these minimum and maximum limits for each of these three key variables. A firm should operate within this particular survival zone. And then, together with all other managerial technologies and methods such as total quality management, continuous improvement, value engineering, target costing helps the company to operate within this survival zone. The triangle of survival zone helps us to understand the purpose of target costing, to enable a firm to operate in the strategic zone of survival, defined in terms of price, quality, and product features. Now, to have a better understanding of what constitutes target costing, we need to pay attention to another triangle. The triangle of target costing. Another triangle introduced and popularized by Robin Cooper and his colleague Regine Slagmulder. Now, according to this triangle, the manner in which a firm would operate in the survival zone, define its price, quality and features, depends on the manner in which a firm would relate to three key strategic actors: the customers, suppliers, and the product designers. And these three actors are located in the three corners of this target costing triangle. Accordingly, if we try to understand or define target costing using this triangle, we can understand target costing as a broad profit management system that try to integrate customers, suppliers, and product designers. In other words, target costing is a broad profit management system that operates by integrating the customers, suppliers, and product designers. And at the center of this target costing triangle, therefore, we have profit management. The ultimate purpose of target costing as a broader management approach is to manage our profit, to make sure that we have sufficient amount of profit to deliver a sufficient, a reasonable rate of return to our investors. And that profit management is operationalized through three interrelated costing activities to be operationalized in three interrelated frontiers of operations. The first one is the market-driven costing, which operates in the frontier of the market, the customer, where we meet our customers, where we face the competitive terrain. So in that particular frontier, we set a specific set of target cost related to the customer, related to the competitive conditions. And those target cost transmit or translate the competitive pressure into the profit management system as a specific set of cost targets. So that is the first frontier, and that is the first activity of target costing. Customer-driven or the market-driven costing. Then the second frontier is the frontier where we face our suppliers. And in that particular frontier, we have the costing activity of component-related target costing. So we have to establish a set of target cost for each component that our suppliers provide us. So in that particular frontier, our focus is on supplier creativity. So we have to maintain and we have to create and we have to sustain a particular set of relationship with our suppliers so that our suppliers are capable of producing and supplying those key components at the target cost that we specify. So that is the second frontier. The frontier between the firm and the supplier where the component related target costs are to be established and operationalized. And the third frontier is where we face our own product designers. And that is where we set our product related target cost or product level target cost. And in that frontier and through that target costing exercise, we focus on our product designers' creativity. Our product designers, our process designers should be creative enough, should be capable of designing and manufacturing a particular product at the specified target cost. So, in a broader sense, target costing is a broader profit management methodology or approach or a philosophy which tries to bring together three key strategic actors: the customers, suppliers, and product designers. And that is done through three interrelated costing activities, operationalized in three interrelated frontiers. The first one is market or the customer driven target cost, to be operationalized in the market frontier, to incorporate, to transmit, to translate the competitive pressure into the profit management system. The second frontier is component level target cost, where the focus is to create supplier creativity or creative connection between supplier and the firm. And third frontier is the product designing, process designing, where product level target cost are to be achieved by enhancing, by focusing on the designer creativity. Then, to connect all these three strategic actors, we have three other related management methodologies or philosophies. To connect our supplier with the customer requirements, with the competitive demands, we have inter-organizational costing. And then to connect our supplier with our product designers, we have value engineering. And thirdly, to connect our customers with our product designers, we have life cycle costing. So this triangle summarizes and captures key elements that constitute target costing. So accordingly, we now understand target costing is not simply a specific, simple technique of estimating or calculating cost of a given cost unit. Instead, it is a broad approach of profit management. Now, with that understanding of target costing as a broader profit management approach, we should now think about target costing as a process. As I discussed in my previous lecture, when we were talking about accounting models of pricing, we understood that cost plus pricing is a push strategy. Cost plus pricing is factory driven, factory based, or production based. It calculates the cost of producing and delivering our goods. And then we add a target profit onto the cost to determine the price. And then we charge and we demand our customers to pay that price. So that manifests a push strategy. Starting from the factory, calculating the cost, adding a profit, and then pushing it onto the customer. In contrast to that, target costing is a pull strategy. Target costing starts from the market and work backward towards the factory to determine the cost at which we have to produce our goods and services. So the starting point is the market. So as this diagram illustrates, we determine a target price for the market by carrying out three interrelated analyses. The first one is we analyze the competitive conditions, or in other words, the nature of the competitive products offered in the market. So we analyze our competitors' offerings in terms of their prices, their quality, and their product features. So basically we analyze the manner in which our competitors operate in that survival zone, and accordingly how we should operate in that particular survival zone. That is the first dimension, first element that we have to take into account in determining our target price. The market and competitive analysis. The price, quality, and product features according to which our competitors operate in the survival zone, and accordingly how we should position ourselves in that competitive or survival zone. And then similarly, we have to have a product requirement analysis. A given product should be defined in terms of particular technological, technical, or any other features. And these requirements may be defined by legal conditions, regulatory requirement, customer preferences, and the basic necessities or functionalities of a product. So in order to qualify your product as one of that particular category of product in operating or being sold in that particular market, you need to have a particular product features. And that product requirement analysis can be technical, can be legal, can be regulatory, or even can be customer preference analysis. And then thirdly, you should also carry out a future technological roadmap analysis. What would be the nature of this particular product in another year, 2 years, 3 years, or 5 years' time? What is the particular technological roadmap this particular industry, this market, this type of products are taking now? So how can we make our current product capable of moving in that direction? How can we incorporate certain initial features, some of those future features, into our product so that we provide the basis upon which we can move? So those kind of analysis will help us to determine an appropriate target price. So that is the starting point of target costing as a process. Then we will carry out a financial analysis to determine what should our target profit. Given our investor base, given the nature of the stock market we are operating, what should be the target rate of return? What should be the overall profitability of the company? And ultimately, what should be the target profit that we have to incorporate, target margin that we have to incorporate into this particular product? And that target profit comes from a financial analysis. So when you deduct your target profit from the target price, you have your target cost, the product level target cost. And then you have to carry out an analysis of your current cost. You have to estimate, you have to calculate what is your current cost of manufacturing, delivering, and so on. And for that purpose, you may carry out and life cycle costing, or you may use activity-based costing or any other cost analysis or costing method. So using various costing methods, you would determine your current cost. And then you have to compare your current cost with your target cost. When you compare your current cost with your target cost, you have a cost differential to manage, a particular cost gap to fill, a particular level by which your current cost has to be reduced. And that cost differential to manage need to be spelled out in terms of functional level target cost, component level target cost, as well as activity level target cost. So in a very broader sense, you have to think about how to manage your overheads related to, for example, manufacturing, sales and marketing, administration, and so on. So which broadly can be categorized as functional level cost targets. And then you have component level cost targets, which you have to manage through your connection between yourself and your suppliers, which we discussed earlier in the name of component level target cost to be managed in the frontier between the supplier and the company. And then thirdly, you have to manage this cost at the very activity level, the specific set of activities that you have to carry out in producing, delivering, marketing, and so on. So how do you keep these activities low? And with the introduction and popularization of activity-based costing, activity analysis play a critical role in managing your cost. And this is again related to your product designers. How do you design and redesign your product and your manufacturing processes and your operational processes, your activity processes? And then for that particular purpose, or in order to achieve all these target costs at the level of function, at the level of component, at the level of activities, at the level of product, and so on, you have to explore product and process design and redesign alternatives. And in that exploration, you will have to carry out various analyses and you have to make various decisions. For example, you have to analyze and make a decision as to whether you are going to make it internally or buy it from externally, a certain component, a certain product element. And then you have to carry out various supplier target costing analysis. How do you manage your supply chain? And similarly, you may carry out a value chain analysis to see which activities can be reduced, which activities can be eliminated, and how that activities can be made more efficient and effective, and how that activities can generate more value, and so on. And also, you have to analyze the cost projections. Given the current market conditions, what would be the cost projections for raw material and other things? So that is exploring product and process redesign possibilities in order to achieve your target cost at the functional level, at product level, at component level, as well as at activity level. Then ultimately, you have to carry out your production and distribution. So when you carry out your production, yet again continuously, in an ongoing manner, you have to keep on costing your product, estimating and calculating the cost of your product. And then you have to keep on having a proper control over your cost, production, and so on. So you need to have operational controls. And then you also have to have Kaizen, or a continuous improvement. How do you improve your production continuously as an ongoing manner. So while you are keep on your production, while you are running your operations, how do you learn? How do you keep learning to reduce your cost, to enhance your production, to improve your quality, to build new product features and so on? So how do you convert your production system into a sort of a learning organization? So that is what they call Kaizen or continuous improvement. So this diagram, they summarize target costing as a process. So with this, I believe now you have a broad understanding of what we mean by target costing. To summarize what we discussed about target costing so far, the first point that we need to keep in our mind is that target costing is not a simple cost estimation or a cost calculation technique. Similar to activity-based costing, job costing, process costing, and so on. Instead, target costing should be conceptualized, understood as a broad approach, a broad managerial approach to manage your profit. And that broad managerial approach can be conceptualized, its purpose can be conceptualized by relating it to the triangle of survival, the survival zone. So the purpose of target costing need to be understood as enabling the company to operate in that survival zone, the strategic zone of survival in terms of price, quality, and the product features. And then we talked about target cost triangle to understand the components or the elements that constitute target costing as a broader system of profit management. In this triangle, as a total conception of target costing, at the very center we have profit management. So accordingly, target costing is a system of profit management. And that system of profit management brings in together, incorporates or consolidate three key strategic actors: customers, suppliers, and the product designers. And that consolidation, that integration of these three key strategic actors are achieved through three sets of costing activities carried out in three strategic frontiers. The first one is market-driven costing, operationalized in the frontier of facing the competition, facing the market, facing the customer. And there the purpose is to translate, to transmit the competitive pressure into the profit management system. Then secondly, in the frontier where we meet our suppliers, the costing activity to be carried out is the component level target costing, which is focused on the supplier creativity. And then in the third frontier, where we are facing our own product designers, our attention is on product level target cost, where the focus is to create and maintain the designer creativity. So three frontiers and three categories of target costing activities: market-driven target costing, component level target costing, and the product level target costing. And then these are connected by three other managerial technologies. One is inter-organizational costing, the other one is value engineering, and the third one is life cycle costing. We will be talking next about life cycle costing, and we will talk about this value engineering and inter-organizational costing and many other elements we mentioned here in our forthcoming lecture, Strategic Cost Management. Now, let's talk about the final element or the theme of this topic, life cycle costing. The concept of life cycle cost is used in two different contexts. The first context is the asset management. In this context, you are thinking about life cycle cost as a buyer or a user of an asset for the purpose of managing that asset. In that context, you want to calculate the total cost of owning and using a particular asset during the whole lifespan of that asset. Accordingly, the total lifespan cost would include the purchasing cost of that asset and then various costs that you have to incur for the use of it, which include, for example, the electricity cost or the fuel cost, maintenance cost, various raw material cost, spare parts cost, and sometimes even certain specific labor cost elements, as well as insurance and other overhead that has to be incurred for the purpose of using this particular asset. And then at the end, you would have to dispose this particular asset. And then what would be the disposal cost of that asset? So you have to put them all together to calculate the total cost of owning and using this particular asset. That is the life cycle cost in the context of asset management. And that life cycle cost can be calculated purely on economic or financial terms. Or alternatively, you may expand this conception of life cycle cost into its environmental and ecological impacts. Especially when you are thinking about sustainability accounting, social and environmental accounting, we would expand the financial calculations of life cycle cost into non-financial dimensions, such as, for example, carbon emissions. So that is how the concept of life cycle cost can be used in the case of asset management, in the context of asset management. And it is a very useful concept in that context. The second context in which the concept of life cycle cost is used is product pricing. That is what we are talking in this particular topic. That is the context relevant for our topic here, strategic pricing. So in that case, we are looking at the life cycle cost as a producer, as a seller of a product. As a concept, the notion of life cycle cost and the life cycle price is a very simple idea, which can easily captured by this formula. Now, according to this formula, you would first calculate the average life cycle cost of the product for the life cycle of the product. To do that, you need to estimate two elements. The first element is the total cost to be incurred throughout the life cycle of the product. And the total life cycle cost can be conceptualized in three different phases. The first phase is the product design or pre-production stage. The total cost of all the cost that you incur during the pre-production stage. That could include, for example, research and development cost, market surveys, product design cost, process designing cost, and all the costs that you have to incur to set up the manufacturing infrastructure, and so on. And they could also include various legal fees to be paid, various licenses to be applied, and so on. So depending on the particular circumstances, depending on the particular case, you have to think about all the cost, the total cost that you have to incur before your production starts. That is what we call pre-production or the design stage. And that design includes the design of the product, design of the process, and design of the infrastructure, and so on. So the total cost to be incurred to make sure that the production or the product is ready to be produced. And then you have the production phase. So in the production phase, you can use your typical accounting techniques of calculating cost. For example, activity-based costing, batch costing, or whatever the costing techniques you are using to estimate the total cost that you have to incur during the production phase. Now, for example, think about a product which you estimate would have 5 years of lifespan. And you assume that in the first year, you estimate that, or you forecast that in the first year, you would have, say for example, 10,000 units to be produced and sold. Second year, your production and sales would be, say, 15,000 units. Third year, it would be 20,000 units. Fourth year, say, it will be 15,000 units. And the last year, it would be 5,000 units. So that is the lifespan. And at the end of the fifth year, you would have to replace your product in the market by your new product. So your estimation is that every 5 years, a new product will be introduced to replace your own old product. So this particular product has a definite lifespan. And then during the first year, using activity-based costing or any other costing methods, you would calculate the variable cost per unit of this particular product. And then you can calculate the total variable cost to be incurred in the first year. Given that you are targeting or you are estimating to produce and sell a particular amount of units. And then you can also calculate your total fixed cost during the first year to produce and distribute and market this particular product. So as in the case of normal operations. So you have the variable cost and you have the fixed cost and you have the total cost for the first year. Similarly for the second year. Similarly for the third year, fourth year and fifth year. So you put them all together, you would have the total cost to be incurred during the 5 years of operations. Total operational cost, including variable and fixed cost, and all committed cost relevant for this particular product. That could include, for example, warranties, guarantees, legal fees, and many other costs. And then at the end of the fifth year, you have to replace this product by another one. So you have to dispose this product. You have to dispose certain element of the production facilities. You have to decommission certain factories and so on. So what is the cost involved or estimated to be the disposal cost, the decommissioning cost and so on. So you have to put them all together. The pre-production stage cost, the total operational cost of the production stage, and then decommissioning or disposal cost. Put them all together, you have the total lifespan cost of this particular product. The total cost to be incurred for this product from pre-production to post-production stage. And then second element that you have to estimate is the total number of units to be sold or produced. So that is your demand forecast. That is your production forecast. So once you get that figure, so you can divide the total life cycle cost by the total number of units to be produced. Then you will have the average cost per unit for the whole lifespan of the product. So to emphasize, so you would calculate the average cost per unit for the whole lifespan of the product. And then you calculate your target profit margin, or the required profit margin. As in the case of cost plus pricing, you add that required profit margin to arrive at your life cycle price. So as a formula, as an equation, it is a very simple idea. And you finally calculate the average cost and average price for the product per unit for the whole lifespan. And it should be emphasized, this particular price you calculated and this particular average cost you calculated is an average figure, a mean value. That doesn't mean that you have to charge this price for this particular product throughout the whole lifespan. Now, this particular average price or average cost would only give you or would provide you a meaningful benchmark, and that is basically an average. Accordingly, you can tweak this average price, modify this average price, depending upon the specific strategic scenarios you are facing. For example, at the very introductory stage, the first phase of your production, first year or so, you might have, for example, a very high price to follow what we call market skimming pricing. A market skimming pricing is a specific pricing approach where you start with a very high price at the beginning of the lifespan of the product. And then when the product gets older and older and older in the market, you reduce your price. So you milk the highest rich layer of the market first, skim it, and then next layer by reducing the price, skim it, and then next layer by reducing the price further, and go on. So that is what you call market skimming pricing. So keeping this average price as a benchmark, you can start with a high price and then later on reducing the price, making sure that you hit this average price. You do not go below this average price. Or as in the case of introductory prices or market penetration prices, you can start with a low price at the very beginning and then increase the price later on as your product grab the market reputation, as your product create a brand loyalty. Then you increase the price. So that all depends on the specific strategic scenarios that you are using. This life cycle price, life cycle cost is an average value. You can tweak your price around it. And similarly, you might charge different prices according to the regions. So you might have different geographical market segments. So each geographical market segments might have a slightly different prices. And similarly, you might have market segments or segmentation might be on different bases. So accordingly, you may charge a slightly different price. But yet again, making sure that you hit this average price. You would not go below this average life cycle price. So this life cycle cost and the life cycle price provide an average benchmark which you have to hit to make sure that you would earn the target profit given your estimated life cycle cost. So that is how you do life cycle costing. So with that, Now we have reached the end of this lecture. So as usual, I would summarize what we discussed for this topic. So as I mentioned at the very beginning, this topic, strategy in the market, strategic pricing decisions, was organized around three key themes. The first one was neoclassical economic model of pricing and accounting model of pricing. We discussed that the neoclassical economic model of pricing is based on the profit maximization objective and mobilizes a particular mathematical proposition about profit maximization. Marginal revenue should be equal to marginal cost. So the price is set where the marginal revenue is equal to marginal cost. Then we critique that particular neoclassical economic model in terms of its profit maximization objective is rather problematic, and the manner in which it captures the market through the demand curve is rather narrow and problematic. And then the neoclassical economic model of pricing does not provide sufficient strategic agency to the firm. So those are the weaknesses we discussed regarding neoclassical economic model of pricing. Then the accounting model of pricing is a very simple model, and it is also called cost plus pricing. So you calculate the total cost of the product, which include direct cost as well as indirect cost. The calculation of direct cost is not the biggest challenge, but calculation of overhead or the indirect cost is the challenge, for which purpose you may use either conventional absorption costing or activity-based costing. So whatever the costing technique you would use, once you calculate the cost, then you add your required profit margin to arrive at your price. And we criticize this accounting model of pricing as totally production driven, totally production based, and manifest a push strategy. It calculates the cost, add a margin, determine the price, and then demand the customer to pay it. Start from the factory and push upon to the customer. And this accounting model of pricing pays no any attention to the market at all. There is no consideration of the competitive terrain at all. That was the fundamental weakness of accounting model of pricing. Then the second theme we discussed was the strategic pricing. So there we discussed that pricing should not be taken as a singular marketing decision. Effective strategic pricing should always be coupled with, integrated with other marketing decisions, such as product, place, and promotion. The ultimate purpose of strategic pricing, together with other marketing decisions, is to create a particular positioning strategy. It could be, for example, cost leadership strategy or a differentiation strategy in a narrow market scope or a broad market scope. Whatever your positioning strategy may be, the ultimate purpose of pricing is to enable and enact that positioning strategy. And for that particular purpose, you have to do three strategic analysis or acts: segmentation, targeting, and positioning. So we discussed these three things: the segmentation, targeting, and positioning. Then finally, in this lecture, we discussed target costing. Target costing is to be understood not simply as a specific cost calculation or cost estimation technique, but target costing is a broad profit management approach. As a profit management approach, target costing tries to bring together three key strategic actors: the customers, suppliers, and the product designers. And that integration of these three key strategic actors is carried out by three interrelated costing activities: market-driven target costing, component-level target costing, and the product-level target costing. So what we mean by target costing is this total package, which also consists of other managerial techniques such as life cycle costing, value engineering, and interorganizational costing. So that is the image picture we learned about target costing. And we also discussed two other important concepts in the context of which we understood target costing. That is the survival zone and the target cost triangle. Then finally, we just discussed now life cycle costing, a technique that we use to incorporate the total cost that we incur during the whole lifespan of a product into our cost calculation and price determination. So with that, I end this lecture. Thank you very much for following this, and see you again in the next lecture.